Friends, if you are receiving Social Security benefits right now, I need you to stop whatever you are doing and watch this video all the way to the end, because what I am about to share with you could save you thousands of dollars. And for some of you, it could save you from a financial disaster that you never even saw coming. We are talking about a tax situation that is catching seniors completely off guard in 2026, and the window to do something about it is closing fast. We are down to 11 days. 11 days to take action before this becomes a much bigger problem than it needs to be. So please grab a pen and paper, sit down somewhere comfortable, and let's walk through this together. Now, I know the word taxes makes a lot of people nervous, and I completely understand that. Nobody wants to hear about the IRS, especially when you are living on a fixed income and every dollar matters. But here is the thing. The seniors who are getting hurt the most right now are not the ones who did something wrong. They are the ones who simply did not know. They were not warned. And that is exactly why we are having this conversation today. Knowledge is your best protection. And by the end of this video, you are going to know exactly what this trap is, whether it applies to you, and what you need to do right now to protect yourself. So let's start from the beginning. A lot of people believe that Social Security benefits are completely tax-free. And for many years, for many seniors, that was true. But that is not the full picture anymore. The IRS has rules that have been in place for a while now, that say if your total income goes above a certain level, a portion of your Social Security benefits becomes taxable. And here is where it gets tricky. The threshold that triggers this taxation has not been adjusted for inflation in decades. That means more and more seniors are getting caught in this net every single year, even people who would not consider themselves high earners at all. Here is how it works. The IRS uses something called your combined income to determine whether your Social Security benefits are taxable. Your combined income is calculated by taking your adjusted gross income, adding any non-taxable interest you earned, and then adding half of your total Social Security benefits for the year. If that combined income number goes above $25,000 for a single filer, or above $32,000 for a married couple filing jointly, then up to 50% of your Social Security benefits could become taxable. And if your combined income goes above $34,000 as a single filer or $44,000 as a married couple, then up to 85% of your Social Security benefits can be taxed. That is a significant amount of money we are talking about. Now, I want you to really sit with that for a moment, because a lot of seniors hear these numbers and think, well, I do not earn that much, so I am probably fine. But here is what so many people miss. It is not just your wages or your pension that counts. It is everything. Your required minimum distributions from your IRA or your 401k, those count. Interest income from a savings account, that counts. Income from a part-time job, that counts. Even certain types of investment income count toward that combined income figure. So someone who is collecting Social Security and also pulling money from a retirement account could easily find themselves over that threshold without even realizing it. And this is where the $75,000 number comes in. We have been seeing situation after situation where seniors who have a combination of Social Security, a modest pension, and retirement account withdrawals are ending up with combined incomes in the range that triggers that 85% taxable threshold. When up to 85% of your Social Security benefit becomes taxable income and you multiply that out over a full year of benefits, you can end up with a federal tax bill that is shocking. For someone receiving around $2,000 a month in Social Security, which is pretty common, that is $24,000 a year in benefits. 85% of that is over $20,000 that could be counted as taxable income. Add your other income sources on top of that, and suddenly you are looking at a total taxable income figure that could push your tax bill into very uncomfortable territory. Over the course of a few years, seniors are finding themselves with back taxes, penalties, and interest that adds up to numbers around $75,000 or more. That is the trap we are talking about. And here is the part that makes this even more painful. Most of the time, this does not hit all at once. It sneaks up on you. You retire, you start collecting Social Security, you start drawing from your retirement accounts, and everything feels fine. Maybe the first year you owe a little more in taxes than you expected. You pay it and move on. But if you do not adjust your withholding or make estimated tax payments, the underpayment starts to accumulate. The IRS charges penalties and interest on top of what you owe, and before long, what started as a manageable situation has turned into a serious financial crisis. So why 11 days? What is happening right now that makes this so urgent? Here is the situation. The first quarter estimated tax payment deadline for 2026 is coming up very soon. For people who are self-employed or who have income that is not subject to automatic withholding, and that includes a lot of retirees, the IRS requires you to make quarterly estimated tax payments throughout the year. If you do not make these payments, or if you underpay them, the IRS can charge you a penalty even if you end up paying everything you owe when you file your return. The first quarter deadline is one of the most commonly missed deadlines by seniors because many retirees simply do not realize that their Social Security and retirement income situation requires them to be making these payments in the first place. If you have not already accounted for the taxes on your Social Security and other retirement income, and you have not set up withholding or made your first quarter estimated payment, you have a very short window right now to get ahead of this before the deadline passes. Missing this deadline does not just mean you owe the tax later. It means you also owe a penalty on top of it, and that penalty is calculated based on the current IRS interest rate, which has been elevated. Every quarter you miss adds more to what you owe, and that is exactly how seniors end up with those large, unexpected tax bills. Now let's talk about what you can actually do. The first thing I want you to do is figure out whether you are even in a situation where your Social Security is taxable. Grab your most recent Social Security statement. You can get this through your My Social Security account at ssa.gov and look at the total annual benefit amount. Then think about all your other sources of income, your pension, your IRA withdrawals, any part-time work income, any interest from savings accounts or CDs. Add all of that together, then add half of your Social Security benefit. If that number is approaching or exceeding $25,000 if you are single, or $32,000 if you are married, you need to take this seriously right now. If you determine that your Social Security benefits are likely taxable this year, there are a couple of ways to handle the tax obligation. One option is to request voluntary federal tax withholding directly from your Social Security payments. You can do this by completing a form called the W-4V, which is the voluntary withholding request. You send that form to your local Social Security office, and they will begin withholding a percentage of your monthly payment. You can choose 7%, 10%, 12%, or 22%, and send it directly to the IRS on your behalf. This is a simple, hands-off way to make sure you are not falling behind on your taxes throughout the year. The other option is to make estimated quarterly tax payments directly to the IRS. You can do this online through the IRS Direct Pay system at irs.gov, or you can mail a check with a payment voucher. The IRS also has a service called EFTPS, the Electronic Federal Tax Payment System, that many people find very convenient. With estimated payments, you are essentially paying your taxes as you go, in 4 installments throughout the year, rather than waiting until you file your return and potentially owing a large lump sum plus penalties. Now, I also want to talk about some strategies that can help reduce the amount of your Social Security that is taxable in the first place. One powerful tool that many seniors are not taking advantage of is the Qualified Charitable Distribution, or QCD. If you are 70 and a half years old or older and you have a traditional IRA, you can direct up to $100,000 per year directly from your IRA to a qualified charity. The incredible benefit here is that this money is not counted as income for tax purposes. It does not show up on your tax return as income, which means it does not increase your combined income and does not push more of your Social Security into taxable territory. If you are already making charitable donations, this is a strategy you absolutely want to discuss with a tax professional or financial advisor. Another strategy is to be thoughtful about when and how much you withdraw from tax deferred retirement accounts, like traditional IRAs and 401k plans. Every dollar you pull out of those accounts counts toward your combined income and could trigger higher taxes on your Social Security. Some seniors find it beneficial to do what is called Roth conversions, moving money from a traditional IRA to a Roth IRA in the years before they start collecting Social Security or in years when their income is lower. Money in a Roth IRA grows tax-free, and withdrawals in retirement are generally tax-free, which means they do not count toward your combined income calculation. This kind of planning takes some time and professional guidance, but for the right person in the right situation, it can save significant amounts of money over the long run. I also want to address something that comes up a lot, and that is the confusion around state taxes on Social Security. At the federal level, we have the rules I just described, but it is important to know that not every state taxes Social Security benefits. In fact, a growing number of states have fully exempted Social Security from state income tax, and others have partial exemptions based on income. So, depending on where you live, your state tax situation may be very different from your federal situation. I strongly encourage you to look up your specific state's rules or ask a local tax professional because the combination of federal and state taxes is what determines your total tax burden, and knowing both sides of that equation is important. Now, here is what I really want you to take away from all of this. The IRS is not going to call you and remind you about this. Social Security is not going to send you a warning letter. Nobody is going to tap you on the shoulder and say, hey, you might be walking into a tax trap. That is not how it works. The responsibility falls on you to understand the rules and take action. And that is not easy when you are managing your health, your family, your daily life, all the things that come with this stage of life. But this is important enough that it is worth a few hours of your time to get it right. If you are not sure where to start, I highly recommend reaching out to a certified public accountant or an enrolled agent, someone who specializes in tax issues for retirees. Many communities also have free tax preparation assistance available through programs like AARP Tax Aid or the IRS Volunteer Income Tax Assistance Program, also known as VITA. These programs provide free help to seniors and people with lower incomes, and the volunteers are trained specifically in tax issues that affect older Americans. You can find these programs through the AARP website or by calling 211, which is a national helpline that connects people with local social services. Also, I want to mention that if you have already filed your 2025 tax return and you found out that you owed a significant amount because of this issue, it is not too late to start adjusting your withholding or making estimated payments for 2026. Every step you take now reduces the problem going forward, and if you owe back taxes from previous years, please do not just ignore it and hope it goes away. The IRS does have payment plans available, and in some cases, hardship provisions for seniors on fixed incomes. Reaching out proactively is always better than waiting for the IRS to reach out to you. Friends, I want you to understand that sharing this information with you is exactly why this channel exists. There are so many seniors out there who are working so hard to make the most of their retirement, and they deserve to know about issues like this before they become emergencies. If this video helped you understand something that you did not know before, please share it with someone you care about. Share it with a friend, a sibling, a neighbor, anyone who is receiving Social Security benefits and might be in this situation without knowing it. You could genuinely be helping someone avoid a financial crisis that changes their retirement. And if you have questions after watching this about your specific situation, about how the calculation works, about what to do next, leave them in the comments below. We read every comment on this channel, and we will do our best to point you in the right direction. This community is here to support each other, and that is what makes it so special. If you have not already subscribed to this channel, please take a moment to do that right now. Hit that subscribe button and turn on the notification bell so that you never miss an update. We post new videos every single day covering Social Security, Medicare, SSI, SSDI, and all the benefit programs that matter to you and your family. Our goal is to make sure you are always informed, always prepared, and never caught off guard by changes that affect your financial security. Thank you so much for watching, stay safe out there, and we will see you in the next video.